Welcome to The Explainer. Today, we're diving into something that's probably a little too familiar for a lot of traders. You know that feeling when you find a perfect trade, it looks totally safe, and then it suddenly goes against you for no reason, only to snap right back and do exactly what you thought it would? Well, if that sounds familiar, you're in the right place.
It's a seriously frustrating question, right? You do everything by the book. You find a clear support level, you put your trade on, and then bam, the price just slices right through it, hits your stop loss, and then it takes off without you. The thing is, according to our source material, that's not just bad luck. It's actually part of the design.
And this quote, man, it just gets right to the heart of it. The whole idea here is that the very same line you see as a safety net, some of the biggest players in the market see as a target. It totally reframes a simple chart pattern into, well, a strategic battleground. And you might be the one in the crosshairs.
I mean, just think about it for a second. When thousands upon thousands of traders all look at the same chart and see the same obvious place to buy, they don't just put their buy orders there. They also put their stop loss orders just below it. And all those stop losses are sell orders, which creates this huge, concentrated pool of money, just sitting there. Our source calls it a pile of dry wood just waiting for a match.
Okay, so to really understand why this keeps happening, we've got to shift our whole perspective. We have to stop thinking like a retail trader and start thinking like an institution. Because in the market, if something looks easy and obvious to everyone, it's usually very, very expensive.
Let's really drill down on this idea of liquidity. See, if you're a massive bank and you need to buy, say, $1 billion worth of something, you can't just click a button like we do. It would move the market too much. You need to find a huge pool of people willing to sell. And where's the biggest, most predictable pool of forced sellers? You guessed it, right below those obvious support levels.
And this, right here, illustrates the whole conflict perfectly. The retail trader is playing defense. They're hoping that line holds. But the institutional player, they're on offense. They see that line as a source of fuel for their own massive orders. It's two completely different games being played on the exact same field.
So how does this whole thing actually play out in real time? Well, it happens through a maneuver that the source calls the stop-loss hunt, and it's a very specific, deliberate, and calculated move.
So you see the sequence here? The trap is set when everyone crowds into the same trade. The stop losses from all those traders create this wave of selling once the price is pushed down. And for the big institutions that needed to place enormous buy orders, well, they're more than happy to step in and absorb all of that selling at a fantastic price. Your loss, quite literally, becomes their perfect entry.
This is what makes it so incredibly maddening. Your analysis was probably spot on. You were right that the price was going to go up from that area. The problem is, you were forced out of your position just moments before the real move happened. The source argues this isn't a failure of your analysis, but a failure to understand the game being played against you.
All right, so we've laid out the problem, and it's a pretty big one. But here's the good news. Our source material proposes a solution. What if, instead of being the victim of this trap, you could actually use it as your signal to get in?
I love this quote because it completely flips the script. You stop trying to predict if the support line will hold. Instead, you start from the assumption that it probably won't hold, at least not at first. You patiently wait for the trap to spring on everybody else, and then you make your move.
So here's the playbook. Step 1, you see the trap being set for others. Step 2, and this is the hard part, you have the patience to just watch it happen. You wait for the sweep. And then step 3, the reclaim, that is the absolute key. When the price moves back above that original level, it's a huge sign that the stop-loss hunt is over and the real intended move is about to begin.
This is the ultimate mindset shift. You look at a chart and you see this long, scary-looking wick that just stabbed through a support level. For most people, that's a sign of weakness, of fear. But with this strategy, that moment of maximum pain for the crowd, that becomes your moment of maximum opportunity. It's not a danger sign, it's an invitation.
Now, to actually trade this way, it takes more than just learning a new pattern on a chart. The source is really clear on this. It requires a fundamental shift in your entire mindset, away from that herd mentality and toward a more independent, patient way of thinking.
The source material uses this quote to draw a really sharp line in the sand. In the market, being the simpleton means just believing the obvious story, believing that a support line is there to support you because a textbook said so. Being prudent, on the other hand, means understanding the deeper game at play and really truly thinking about why you're taking a step.
And it really all boils down to this choice, laid out perfectly here. Are you going to be the trader who just follows the crowd, buying where everyone else is buying? Or are you going to be the trader who has the patience and the nerve to stand still while everyone else runs, waiting for the trap to spring so you can take advantage of it?
And that's really the ultimate question this whole idea leaves us with. Once you understand the game of liquidity and stop-loss hunts, you're forced to look in the mirror and ask yourself, which one am I? By changing the way you think, you can start to make that critical shift, from being the liquidity that gets hunted to being the one who uses it.